Now, that's where things become interesting. Because if we start to take a look at bond yields, the Bank of Canada increased interest rates by 0.5% to 4.25% this week, but that is not the story here. The real story is the fact that bond yields have continued to go down even though the Bank of Canada is increasing interest rates. And that, combined with the shift in language from the Bank of Canada, has shifted the narrative around fixed versus variable rate mortgages, making fixed rate mortgages a more attractive option for first-time homebuyers, as well as those who have variable rate mortgages and are looking to lock in. Because for the first time in quite some time, we have a very clear indication of where interest rates are going for the next year or so. We know exactly what the Bank of Canada is looking at when they make their rate decisions. And I'm going to show you how you can make decisions based on that information at the end of this video. But before we get into it, my name is Nolan Matthias, and if you want to thrive financially, this is the place for you. So go ahead, click that subscribe button and hit that like button so more people like you can see this video. Okay, so let's get into it. Obviously, the Bank of Canada increased interest rates by 0.5% to 4.25%. If you don't know that already, you've been living under a rock, because pretty much every mortgage broker, every realtor has been out there posting on the Instagrams and the YouTubes and all of those things that those rates have gone up. And this represents the 7th mega increase in interest rates this year. But again, like I said in the intro, this is not the story. The story is that bond yields are going down while the Bank of Canada continues to increase interest rates. And what this means is that the markets are expecting that we've reached the top of the market with respect to interest rate increases. But I don't necessarily think that's true. I think we're going to see more interest rate increases in 2023, but they're going to be more measured. In fact, the Bank of Canada told us this week exactly what they're looking at in order to make their interest rate decisions. And I'm going to tell you a little bit more about that in a second. But first, I want to take a look at what's happening with the wording from the Bank of Canada. So obviously, pretty much every news outlet picked up on this story. Of course they did. It's major news when the Bank of Canada changes interest rates. And I want to show you basically what pretty much every news source said when they looked at the policy decision here. And here's a statement that most of the news outlets picked up on. And this is actually very important, believe it or not. Just one paragraph in the statement is hugely, hugely important with respect to the direction that the Bank of Canada is moving. So the statement was this: Governing Council will be considering whether the policy rate needs to rise further to bring supply and demand back into balance and return inflation to target. Now, what they had previously said, I'm going to paraphrase here, is that we foresee that further interest rate increases are going to have to happen. Now, what they're saying is that they're going to continue to look at what's happening in the economy and whether or not we need to have further interest rate increases to bring supply and demand back into balance. And further, the following day, Sharon Koziski, one of the deputy governors of the Bank of Canada, gave a speech at the Urban Development Institute in Quebec. And what she said is that our deliberations are centered on 3 areas we said we would be watching closely: how supply challenges are resolving, how higher interest rates are slowing demand, and how inflation and inflation expectations are evolving. So in other words, these are the 3 primary things that they're looking at with respect to inflation and whether or not they're going to increase interest rates. And I think what they've very much made clear here is that they're shifting from how much do we need to increase interest rates to whether we need to actually increase them going forward. So going forward, based on these things, the supply issues, the demand issues, and whether or not inflation is becoming entrenched in the economy, we can start to make reasonable decisions with respect to our expectations on interest rates going forward. So what we're more likely to see in the near future here is more measured decisions. So in other words, we're probably going to return back to 1/4 point increases rather than 1/2 point increases. And as inflation starts to come down, we'll start to see less increases. Now, if inflation spikes, we'll see more increases. The question though is, how long will it take before we see interest rates start to come down? And here's my expectation based on everything the Bank of Canada said in the last couple of days, as well as what I expect that they're going to say on Monday when Tiff Macklem, the Bank of Canada governor, gives a speech in Vancouver, his year-end speech. My expectation is very much that throughout 2023, we are not going to see any interest rate decreases. Now, I know some economists have predicted that this could happen, and if inflation comes down drastically, it very well could. But I think for the most part, if we expect that inflation is going to remain pretty much consistent over the next little while, we can also expect that interest rates are going to remain consistent or slightly higher as well. Now, keep in mind that those are not predictions. That is just perspective. We're taking a look at all the data from all the different news sources, and we're trying to create our own narrative and our own views on what could happen. And then we make our decisions from there. So I would expect somebody who is getting a mortgage or somebody who is watching these things and who is concerned about interest rates to go and do the same. Just don't watch this video and take my word for it. Go and watch everyone else's videos. Go and read the news articles, read the actual Bank of Canada releases, and develop your own perspective. But for me, I believe that everything we're being told right now indicates that we're going to end up with consistent interest rates throughout 2023, and we're probably not going to see any drops. Now, that's where things become interesting, because if we start to take a look at bond yields have dropped below 3% for the first time in quite some time. In fact, I'm pretty sure it's the lowest that they've been since September. Yep, if you go back and you take a look, going back to basically the end of August, interest rates are the lowest that they have been since August 18th. Now, these are the bond yields. The bond yields affect fixed rate mortgages, which means fixed rate mortgages have not only come down, but they also have more bandwidth to continue to come down. And the reason that the bond yields are coming down is because the expectations of the markets is that we are going to see more recessionary pressure and that increases to interest rates are starting to come to a halt. So what does this mean? Well, it means that for the first time in quite some time, you can get a fixed rate mortgage for cheaper than you can get a variable rate mortgage. With banks raising their prime to 6.45%, most variable rate mortgages are going to be priced higher than 5.45%. You can also now get a 5-year fixed for 4.89% or a 3-year for just above 5%. So what that means is that you can now get a fixed rate mortgage for a lower price than what you can get a variable rate mortgage for. And with what we know about the economy, what they are looking at, and how high inflation is compared to the target of where they want it to be, well, we can pretty much choose a fixed rate mortgage now, knowing that interest rates are probably going to increase slightly in 2023, and that we're going to probably have a year or two of interest rate increases and then maybe small declines that would make it beneficial to have a fixed rate mortgage, because the chances of the variable rate mortgages getting back down to the price that fixed rates are at right now is very small. Now, if we have some sort of major financial catastrophe or some sort of pandemic again, that could be a completely different story. However, we can pretty much take a short-term fixed rate mortgage and rest assured that it is going to perform better. And by the way, my wife and I did this back in 2016. We took a 2-year mortgage rather than a variable rate because we could get the 2-year mortgage for cheaper than the variable rate, and it proved to be a really good decision. But there's some important things that you need to consider before you do this. First and foremost is where you're getting your mortgage. If you are taking a fixed rate mortgage, you are absolutely crazy if you get it at a big bank. If you can get a fixed rate mortgage at a mortgage lender that specializes in mortgages, so a First National, a CMLS, or an MCAP, that is a far better choice than choosing a BMO or an RBC or a CIBC or a Scotiabank or a TD Bank. And the reason why is quite simple. The penalty exposure is substantially lower at lenders like CMLS and MCAP and First National. And you want to make sure that you have a lower penalty when you're getting a fixed rate mortgage. The reason why is quite simple, is because if interest rates do start to go down, you want to be able to refinance and get into that lower interest rate. And the one thing that allows you to do that is by having a lower penalty. Now, in addition to that, if you are a variable rate mortgage holder, it may make sense right now for you to consider locking in. Now, I wouldn't necessarily recommend locking into a 5-year fixed, although if the last 8 to 12 months have scared the heck out of you and you want to do that, now is actually looking to be a pretty good time to do that, because you can get into those 5-year fixed mortgages around 4.89%. But my recommendation would be more towards a 3-year mortgage, so we can take advantage of the fixed rates, but also kind of see what happens over the next 2 to 3 years with respect to interest rates, and maybe shift back to a variable rate strategy if interest rates do start to go down, or they seem like they're heading towards a more normal interest rate environment. Regardless, even though hindsight seems like fixed rates might have made sense last year or the year before, the reality is nobody had a crystal ball that could forecast what was going to happen in the economy and the high inflation rates. However, at this point, we know that inflation still remains high. We know the Bank of Canada is backing off on their interest rate increases, and we know that the interest rate increases are going to be smaller going forward, which means with fixed rates being lower than variable rates, we can choose a fixed rate mortgage right now, knowing that it's probably the right choice. And by the way, if you want to know more about the conversation between fixed rates and variable rates, go ahead and check out this video right here.